All right. It is now time to get going. Thanks everyone for joining us. You should be able to see my screen. Right now, it's just a whiteboard, but we're going to dive into some things today. Today's webinar is going to be focused on a topic that comes up quite a bit. And it's one of those things that is simple but complicated. Simple but complicated. And I find that's the case with a lot of things in life. The computer that I'm using right now, man, they make it really pretty simple for me to use. I'm not technologically advanced at all, but I do know that it's very complex. The machinery is, and I know how to use it for what I need it to do. There's some things about it I don't fully understand, and that's what's going to happen today. So today we're going to talk about how a policy can pay for itself. It actually is very, very, very simple. It really is simple. But the problem is that we can overthink things, and maybe we have some misunderstandings of how the policies really work or what the premium is. So today we are going to talk about this concept of a policy paying for itself. How does it do it? When is it a good idea? When's it not a good idea? How we should even really be seeing the premium to begin with. So that's what we're going to dive into today. And I wanted to say something. You know what was funny? Just let me bear with me as I say one more thing. I remember now the guy who wrote this to me. He might be on the call, but I got an email from somebody after one of the last webinars I did. He said something like, "Hey Nate, you do a great job making this prepared presentation seem so I don't know what spur of the moment, or yeah, I can't remember the words he was using, but essentially you don't, this doesn't sound very canned." And I think that was meant as a compliment, but it was also kind of funny that he was saying it's a prepared presentation. All these webinars I do, including this one, this is the first time I've ever done it. I've never actually sat down and for an hour just described how to do this. Now I've been sitting with clients before, and I've answered questions on it, showed some things for it, and just try to share some ideas. But this is the first time we've ever done this, so this is not going to be a nice little start to finish thing. There's going to be some things I'm going to just kind of jump in with what I'm thinking about as I see it. Now, of course, I've got a little bit of a plan here. I built some sample policy illustrations to show these things. But it's certainly not canned at all. It's not even really a presentation. It's just like a conversation here on how these policies really work. And one thing I wanted to mention here is I have a bit of a problem with where this question, or why this question even comes up for most of us. So most of us, when we get started, this includes me. Okay, so most of us, when we get started with this concept, we start policies. We have this premium, and we have a pre-existing idea of what a premium is. And we see some examples out there. Maybe it's our examples or Nelson Nash's books, examples of policies having a limited premium payment period, where make 5 years, 7 years, something like that, and the policies stop. We stop sending money to the policies, and we have this idea that we want that. And whether or not we realize it or not, it typically comes from the idea that we see a premium as a payment that we have to make. And nobody really likes making payments or having an obligation that they're setting themselves up in the future. So we think, man, I can't wait to get rid of this stupid premium. And we've told many stories, some of you may remember Ray's mom told that to him. So, years ago, and that's a story in and of itself. But all that to say, we normally have this pre-existing idea of what a premium is. We don't really like it. We want it to stop at some point, or we get concerned about it. And mainly, that just comes from a misunderstanding of what's actually going on in the policy. And so whenever we describe the premium paying for itself, unfortunately, most of those discussions come in from somebody saying, I can't wait to stop paying the premiums. When can I get rid of this stupid premium? One of my goals for this webinar is actually, though I am going to show you how to do it, my goal would be that you would really want to. And I hope I can share that with you. So I'm going to show you exactly how you can do it. And there's 3 ways to do it. I'm going to show you all 3, and we're going to dive into that. But I hope that you understand that actually by looking at this, you'll see that it's maybe simpler than you thought that it can do it, and maybe makes you see the policies in a more flexible light than you have. And I hope to even see that you see the premium newly, have a new idea of what a premium is, how it benefits you, what happens in the policy when you pay it. Really see, by the way, what it does. Your actions just show that you don't believe that it's true. Now, I say that because I know that was the case for me. I remember when I got started, um, I started policies. And if you're like me, this is how you get started with policies. You hear the concept, you're like, this is great. But you have this idea of this premium. We got to keep paying into it. What is that all about? And so what we do is we say, okay, I want to make sure that I can pay, whatever premium amount I decide to do for my very first policy. I want to make sure it's low enough that if crap hits the fan, I'm still going to be able to pay this premium, right? So, this is just normal. This was me. It's no longer me. That was me. This is pretty much everyone starts there. So we go out and we say, you know what? In my business, my income is very up and down. 1 year can be great, 1 year can be bad. You just don't know if you're a business owner exactly what's going to happen. Now, hopefully, go on an ever upward basis, but there's no guarantee of that. So I told myself, as I'm going to get started, and as I was opening new policies early on, I was like, okay, well, what if I have a bad year? Could I still pay the premium? Essentially, what I was saying is, I always believed I had to make sure that I earned enough money to save enough money to pay the premium. And if I didn't earn enough money to save enough money to pay the premium, something bad would happen to me or I shouldn't do it. And that has changed. It's changed. I'm no longer afraid of whether or not I can or can't pay a premium in the future. So someone just asked, are we supposed to be viewing your blank screen? Yep, I can draw a little smiley face on here for us. I'm about to dive in. So thanks for your patience. I'm about to dive into a real, the real gist of it, but just this is my super long introduction. Let's go ahead and dive in. I don't want to waste anybody's time. So what I want to do is I want to have a kind of a baseline policy, where I'm not paying for itself. It's just a normal policy. This is what do you want to call that? Like the placebo of this scenario, or and so this is just a normal policy that we would build for anyone really. And there's two. By the way, this is not a webinar where I'm going to describe everything on these illustration pages. I don't have enough time. So this webinar is solely for a focus on how to policy pay for itself. So I'm gonna highlight a couple things here really quick. The main two columns we are going to care about in this discussion is the premium column. That's how much I'm going to put in, and my total surrender value, or that's another fancy word for your cash value. So these are the two columns as a banker that we care about. How much money am I putting in? How much can I use? And in this scenario, you'll notice that we pay a premium. He starts this is a $20,000 a year premium policy, fairly normal. And he puts in $20,000 a year for 7 years. And then you'll notice something changes in his premium. He actually stops putting in the full 20 and just puts in 8,000. What's happening here is that we are no longer putting money into the paid up additions rider. For those of you who are already clients who already own policies, this is very familiar to you, and this language is probably fairly familiar. If you're brand new and you're literally diving in the deep end of the pool without learning anything else, this might be confusing, in which case I just don't have enough time to answer everything about this. So what's happening here is we're going to pay a premium, $20,000 a year for 7 years, and then we're going to stop paying the paid up addition rider and keep funding just the base premium portion of this policy from then on. This is our basic scenario here, and all the other policies are going to be doing the exact same thing, just with some premiums being paid in other ways. So all of these premiums assume we write them a check from money that was not already in the policy to begin with. That's what's assuming here. Obviously, we're paying the premium from other money. And this is what a normal policy looks like. And so when we meet with somebody, they may say, well, Nate, you think, and if I scrolled all the way down this policy, which would be multiple pages, if I scroll all the way down, you'll notice there's an $8,000 premium until this person is age 121. And so some people will take a look at that and they'll say, Nate, you're telling me for this policy, I got to write a check for at least $8,000 every year for the rest of my life till age 121? How am I going to be able to do that? And man, that's pretty hardcore. And so, in other words, that's part of the problem is seeing a premium as a payment or a liability, an obligation we have to make. And so, but either way, that's where this all starts. And so we've got this premium going on forever. We all know that at some point in time, chances that we're actually going to be earning money and paying a premium for this policy is slim. We're going to at one point not only be not adding money to it, we're going to be pulling money from the policy to produce passive income. So there's got to be a change at some point. And that's what we're going to talk about. But either way, if we go down to year 8, I just want to show you what's happening. Let's just take a quick look at what's happening. So in year 8, we pay this $8,000 premium. I'm going to jaunt over here to the cash value. And what you'll see from year 7 to year 8 is our cash value increased. If you do math the same way I do, and I do it really quick here, it grew from 132 to 147. So we wrote a check for $8,000 of premium. That produced $15,000 of cash value for us to work with. Now, this is just a side note here. It doesn't seem too hard for me to find $8,000 if I know that I can scrounge it up somehow, send it to the insurance company, and that year I can have them send me back $15,000 in cash value. If you don't want to be doing that, there's not much I can do to help. We just earned $7,000 of profit tax-free just by moving the money in. So at this stage in time, we can all take a look at this and say, you know what? We're doing pretty good. At least that's what it looks like to me. I can write a check for $8,000. They're going to give me back $15,000 this year. Heck, I'll take it. I'll take a few of these. Take as many of these as I can get. And so this is the baseline here. But what if, let me erase this. What if we are here in year 7, you've got $132,000 in your policy here in year 7, and you come to me in year 8 and you say, Nate, I'm broke, man. Lost my job or something happened. The kids are going off to college. I don't have any money to pay this stupid $8,000 premium. Well, my first comment would probably be, you know what, client, you actually do. And none of my clients talk to me like that, but you actually do have the money to pay this premium. It may not be in a checking account somewhere or sitting around doing nothing outside the policy, but you've got $132,000 of cash value. You have plenty of money for an $8,000 premium. What if we just use the cash value we have in the policy to pay this premium? And right here, I'm going to stop. Because at this moment in time, most of us have an idea that this is not a good thing. Most of the time, whenever I hear, talk to people about policies paying for themselves, they think that let's say the dividend has to be greater than $8,000 for a policy to be able to pay for itself. That's incorrect. They may think that if I use my cash value to pay this $8,000 premium, I'm going to have a reduction. I'm going to be taking $8,000 of my money and it's going to be gone. I've got 132 now. If I take 8 to pay this premium, man, that's a big chomp out of my money. It means I'm going to lose $8,000. That's what we think. What I'm saying is that's what you believe, whether or not that's what you think is right. And the reason I know that is because almost everyone I've talked to has felt that way. Whether or not they would verbalize that way, that's what they're thinking. Oh, if I have my policy pay for itself, I'm going to be draining my account somehow or reducing it. And I just want you guys to know that's actually not what's happening. I'm going to prove it to you in 3 ways. 3 ways. But let's just assume right here as we're just having fun that we say, you know what, let's take out a policy loan. Let's do that. You got $132,000. Why don't you just ask the insurance company for an $8,000 policy loan? And they cut you a check. Your premium's coming due soon. They cut you a check for $8,000. They send it to you in a loan balance. And you take that $8,000 loan that you just pulled out and you use it to pay your premium. So did you use any money out of pocket? No, not really. I mean, we asked for $8,000. They sent you a check. And then we sent that money right back to them. That's all we did. In fact, you wouldn't really do that in reality. What would you do? You just call them on the phone and have them pay the premium internally without ever sending any checks. Just an internal little rotation of money. And if you've been following along with us, you know that a policy loan does not impact your cash value. Does that make sense? We took our 132,000 of cash value. We took an $8,000 collateralized loan. We used our policy as collateral to receive a loan from the insurance company. But here's the key. We didn't take that loan and blow it at a casino. We didn't cash the check and light the cash on fire. What did we do with the policy loan? We used it to pay a premium. Well, what is going to happen in this? Don't overthink this, guys. This is not, I'm going to go prove it to you in a second with in the illustration, but what I'm just saying is this is simpler, it's complex, but it's simpler than what I think we give it credit for. We use this loan to pay a premium. So what is my cash value going to be in year 8? Well, it's going to be, if I took an $8,000 policy loan out, my cash value, and I used it to pay this premium of $8,000 that came due, my cash value is still going to be $147,415 to the dot, to the T. No changes there. What's going to be different about this? There's going to be a new column that's going to be added to this illustration. What's that column called? It's called a loan balance. Called a loan balance. It'll go right in here somewhere. We have a loan balance on this policy. You hear me? And if we had taken an $8,000 loan at, let's say 5%, which is what the policy loan rate typically is at most mutual insurance companies right now. If at 8,005%, then our loan balance at the end of the year will be $8,400. $8,400, $8,000 loan at 5% for 1 year. So at the end of the year, our cash value going to be, our total cash value, is it going to be $147,415? That is how much money we're going to have in this policy earning interest and, or guaranteed cash value growth and dividends. But what's going to change is there's going to be that new column here right next to it, $8,400. So if I do some little quick math with a calculator, I'll show you how much money we have. We have $147,415 of cash value, of which we've borrowed and have a loan balance of $8,400. So this tells me that my net cash value, the net means whatever the cash value is minus whatever loan balances you have on the policy. My net cash value is going to be $139,015. You got it? How much did I have the year before when I didn't, in year 7 before I paid the premium to anything? I had $132,000. So I had $132,000. I didn't send any money out of my pocket, and now I have a net of $139,000. Do you see how we still receive that $7,000 profit? Why did we not lose money here? We didn't. We had the cash value pay for its own premium. Shouldn't I have less money than I started? No, you shouldn't. Why? Because the premium is not an expense. We did not blow our $8,000 at the casino. We did not light it on fire. We literally just moved money. I hope you see that. It's called a cycle. We took some money out real quick. We put it right back in. In other words, we had 132. We subtracted 8. We had 124. We put the 8 back in. We're back up at 132. And that 132 is earning interest and dividends inside of the policy. So this is the basis of how it works. That was one way to do it. But let me go, just keep beating the dead horse here. Let me put this down. And I think some people are asking questions. Potentially, just hold tight. I'm going to have question time at the end. So I'm going to pull over to this, and I got someone raise their hand. Guys, I won't be able to stop mid-webinar. So save your questions for the end. Save it for the end. So I'm going to pull over to this page. This is the same exact policy. I can get my pen to operate accordingly. Here we go. The same exact policy. $20,000 a year for 7 years. If you'll remember having that, the cash value is right over here. We have $132,000 of cash value in year 7. I know I'm just trying to say this is the same policy that we had on that other screen. The only difference is I'm actually going to have the illustration software pay for the policy premium without us sending any money. And this first option, we are going to have it borrow the money every single year for the rest of our life to pay the premium. And you'll see that happening. You'll notice the net cash outlay column. That's a new column. There's some new columns on this one because we're doing some things within the policy, some loans and stuff like that. And so you'll notice for 7 years, we put in 20 grand, but then it goes to zero. That's because starting in year 8, just like we had done hypothetically on that previous page, the same thing goes for this page here. And the reason I'm showing how to pay for a policy premium using a loan first, this is the first thing I'm doing, is because this is the most common way to do it in ordinary circumstances for most people. And there's a reason for that I'm going to talk about in a second. But so to go in here, what we have is $132,000 of cash value in year 7. You come to me in year 8, again, you say, Nate, I don't have this $8,000 of cash sitting in a bank account somewhere. I've only got this policy and it's got this money in it, but I can't write this check for $8,000. I tell me, oh, and that's okay. That's okay. Let's go ahead and figure this thing out. So what we're going to do here, client, is we're going to take a policy loan out for $8,000. You'll see that right here. We're going to take a loan out for $8,000 to pay this premium so that you don't have any outlay out of your pocket. In fact, we'll just have the insurance company do it internally. We'll just call them and say, hey, can you do an automatic premium loan? Just automatically pay the premium with the policy loan. They say, sure. So they take $8,000 out. They use it to pay the premium, which does what to our cash value? Boosts it right back up. So once again, we have an $8,000 policy loan. Here's our policy loan interest that I talked about. The last one, $8,000 at 5% is $400 for a year. So what's our loan balance at the end of this year? It's $8,400. Look at this. Our net cash value is $139.15. Do you see that? $139.15. Do you happen to remember that calculation we did on our last graph when we were just talking hypothetically? Do you remember, if I scroll back for a second, do you remember that we took our $147,000 of cash value, the $147,415, and we subtracted out the $8,400 loan balance, and that gave us $139,015? All I'm trying to do is prove to you that if it works hypothetically, it probably works in reality. So all I'm trying to say is I'm not trying to bamboozle you. That's exactly what's happening here. How much cash value do we still have in this guy's scenario? We have $147,000, but our net cash value is $139,000. So did we write a check to pay a premium on this policy? No, I mean, not out of our pocket. We just used the existing cash value to pay its own premium. So we had no outlay going in from out of pocket, but we received $7,000 of increase. We're doing okay. But I also wanted to make a point, this kind of stress a different point here, I guess, that you'll notice that the dividend in year 8 was $1,556. $1,556. What was the dividend when we didn't take a loan to pay for the premium? Let me go back over here. Erase something. This was our litmus test. This was the policy that we didn't do anything with. We go over here in year 8. We go over to our dividend in year 8. It's the same. Why is it the same? Why is it the same? It's because, once again, I'm just beating a dead horse here, but I'm really trying to pound this home. A policy loan does not change the trajectory of your policy. It's a collateralized loan against your cash values. The policy is going to be growing exactly the same way. We could even do the same thing. Let's look at year 20. What's our dividend in year 20 when we paid all the premiums out of our pocket? $8,000 a year. What's it in year 20? 5,843. Let me go back to the policy loan. I'm actually hoping this is right. I didn't prepare this. I'm just saying in year 20, I would expect my annual dividend that year to be 5,843. Why is that? That's because we're not withdrawing any money from this policy. We are borrowing against it to pay its own premium. That's why the policy, and that's the reason why the loan is the most common way to pay for your own premium. It's the most flexible way because your policy actually gets to stay on its same trajectory. Like if this is the trajectory of your policy right here, going compound interest trajectory, we can take loans out, but that actually in all these years, but that doesn't change the overall trajectory of the policy itself. It's going to keep on going exactly the same way. We just have this new loan balance column that's building up over here. So the policy keeps compounding on the full amount while we have a loan on the side that's compounding. And that's why you see, I mean, you guys can look at numbers, and I'm sure you all are, and you can see how the annual loan that we're taking every year gets larger. I would like to just ask you why you think that's going on. If the premium's 8,000, why does the loan keep going up? And I think some of you may be able to see a system here. In other words, like in year 9, we took out $8,400 loan. Why is that? Well, we needed to pay this premium of $8,000, but this $400 of interest that was billed on your premium statement at the end of year 8, that you're broke in year 8. Remember, you don't have any money. You don't have $8,000 to pay the premium. You don't have $400 to pay the loan interest on the loan we took. So how's that going to get paid? The loan interest. It's just going to get added to the loan balance. Or in this case, as you can see, what they're saying is essentially you're just taking out in year 9 an $8,400 loan. $8,000 pay the premium, $400 to pay the interest. And that's what keeps on happening every year. You'll notice a correlation between the interest owed 1 year and the loan owed in the next year. You guys see that? I'm not going to spend a lot of time there. That has nothing to do with policies paying for itself. But essentially, all I'm saying is we're borrowing money to pay this policy, and we can go for forever. I wanted to mention one more thing too. These hypothetical thoughts. Remember, when we're taking a policy loan out to pay a premium, the trajectory of our policy should still remain the same. So why does a policy continue to grow even if we're borrowing to pay its premium? Because 100% of the cash value is growing and compounding on the full amount the entire time. And the loans that we're taking are not getting blown at the casino. They are just paying the premium, which produces new cash value. But if I wanted to take a look at year 20 again, I would expect a couple of things to be happening. I hope this works out appropriately because I could make a fool of myself if it doesn't. But I would expect for my loan balance in that year and my net cash value that year, if I add these together, my loan balance and my net cash value, if I add these two numbers together, I would expect that to be the exact amount of gross cash value, total cash value that was in our sample policy where we just paid the premium out of pocket the whole time. So let's do that. Let's just hope this works. Let's try it. If I take the 148,081 and I add, that's our loan balance. So we borrowed money for all these years, pay premiums, haven't been paying out of pocket. We've just been letting the loan balance accrue with interest, not paying any of the interest. That's how much money we borrowed out. We add that to our 237,160 of cash value, and this shows my gross cash value should be 385,241, of which I borrowed 148 to pay these premiums, so I'm left with 237 net. Let's go back. Click over. Go back down here. Age 60 of this guy, 20 years down the road. I'm on this little break here. My total surrender value is right here. I've got 385,241. Yep, exactly the same. So in other words, by using policy loans to pay my premiums over that period of time, I never got off the trajectory I was supposed to be on, which is what I love about it. So in other words, that's the reason I showed this first and foremost is because I think it's the most common and most popular option, because at any given point in time in the future, you can choose to repay any of the policy loans you've taken and be right back where you were supposed to be in the first place, assuming you had paid all the premiums that whole time out of pocket. That's powerful. So in other words, in year 20, yeah, we've got, what was that, like $148,000 loan balance. We could write them a check for 148 that year and be right back, right where we were supposed to be the entire time, assuming we had been able to pay all the premiums we wanted to pay and build the policy the way we wanted to build it. That's very powerful. In fact, this is why I have changed my mentality on it. This is why I've changed and I've even started new policies using loans from existing policies, because I know that those loans on the existing policies are not going to affect the future value of those policies. And I can get a new policy system built up. Obviously, the whole goal of getting that new policy built is to get to these years where I'm writing a check for 8,000 of premium and my cash value is growing by 15,000. Like let's say here in this case that happened to this guy in year 8. That's pretty good. I wouldn't mind writing a check for 80,000 and getting 150,000 if I had 10 of these things. That sounds pretty good to me. So what I'm trying to get at here is I'm just trying to get policies built, even if I'm moving money from one to the next. And maybe that's due to my optimism, my optimistic view of my income in the future. I just expect that at some point, yeah, I'm probably gonna be able to repay that policy loan. Even if I don't, I'm doing great. Okay, but if I do, I've got all those policies built. They've been around for a long time. And I just replenished what I had taken out, and I'm right back on the right trajectory on every policy I'd ever opened. So Nelson Nash talks about that a little bit, especially in his second book, The Warehouse of Wealth, where he talks about having room for windfalls. And you can do that by using policy loans to pay for premiums on your existing policy or other ones. The key is just getting more and more money into policy. So I hope this was helpful on this first note, that we can take policy loans to pay a premium. You'll notice our cash value continues to go up, and it will forever, but I'm not going to go all the way down to age 121 and just scroll through 4 pages of numbers. But essentially, yeah, we can have the policy pay for itself for the entire time and continue to grow. Why is that? It seems counterintuitive. It's because the premium's not an expense. We didn't blow the money. We use it to pay a premium. We're just cycling money in and out. We can talk about it more in detail if you'd like another time. So that's the first option, but there's 2 more, by the way. There's 2 other options. They're not quite as flexible. I don't like them as much, but there's reason to do them depending on where you're at, what your policy is looking like, and so forth. So let me go flip over to this one. This is the same. Excuse me. Accidentally hit a button. This is the same policy, $20,000 a year for 7 years, and then dropping down to the base premium of $8,000. Our total surrender value is right here on this illustration, just to make a little hyperlink. We're still at that $132,116 of cash value in year 7. Just trying to show you that, same policy, same design. This is just another way to pay a premium. The last time we had taken loans out to pay a premium. This time we're going to do something different. This time, you'll notice there's no loan balance anywhere on the screen. There's this column here, though, that says that we're surrendering paid-up addition, or we're surrendering cash value. That's a fancy term. Essentially, how we relate to that is that we're withdrawing $8,000 a year to pay our premium. There's no loan interest being charged. There's no loan balance whatsoever. But the difference between this concept and the other one is that we are now going to change the trajectory of the policy. It's not necessarily a bad thing. We're not going to pay any premium out of pocket. So we would expect that the numbers, are different. In other words, I'm not recommending people pay the premium out of pocket. In other words, if you we go back to the original policy in year 20, we had $385,241. When we borrowed money in year 20, we had $237,160. Which one do you like better, 385 or 237? Obviously, we like the 385. Why does the first option have more than this one? It's because we paid all the premiums out of pocket. We didn't have to borrow any money to pay it. Did we hurt ourselves by paying it? No, we didn't. We're still profitable. We were just changing how much money's been put in. Does that make sense? I hope it makes sense. We've changed how much money we put in. So the amount, so we would expect, in other words, it's not magic money, but the same thing goes for the withdrawals system. And here we actually do take cash value out of our policy. And then we use that cash value to pay a premium, which then puts cash value back in the policy. That's what we're doing here. This is just like a bank account. We took out a withdrawal and we made a deposit. But we have changed how much money is compounding now in the policy. But that doesn't really mean we're worse off. And we don't have a loan balance compounding alongside of it. We're in about the same boat. A loan can work a little bit better, but we're in about the same boat. And the reason I can say that is look, we started the year with 132. You come to me, you say, Nate, I don't got $8,000 for year 8. I got no money. I say, of course you do. Let's just use the cash value that exists to pay the premium. In this case, we'll take a surrender or a withdrawal of money. We'll use that to pay your premium. It's going to put the money back into the cash value, plus it's going to be earning. Well, how much money did we have at the end of year 8? $139,000. What was our outlay this year out of our pocket? $0. You notice that $7,000 profit the policy was producing is still yours. Whether or not you wrote them a check for the premium or you used the cash value, didn't matter if we took a loan out or if we took a surrender. The surrender is if you took a loan out to pay the premium, it was right at 139.15. That's how much we had in cash value net of the loan. Here we have 139.12. How we doing? We're $3 apart for in the next year. So what I'm trying to say is, in this case, it's a little bit different. We actually changed the trajectory of the policy, which is why I prefer for most people to do the policy loan option, unless you're just concerned about having a loan balance and just want to do it this way. That's fine, but you can never replace this money that you withdrew if you're surrendering it. In other words, we're withdrawing this money. We can't go to year 20 and have the opportunity to write a check for $100,000 and put it all back. We don't have that opportunity. So we have less flexibility. We've changed the trajectory of the policy to someone. Once again, I'm saying these words and I think people are hearing, oh, you hurt the policy. Did we? Yeah, it would have been better if you wrote a check for $8,000. It would have been better. It doesn't matter which scenario we choose. You will have more money the more premiums you put in to your policy. That's period. Did you hurt yourself? That answer is technically no. We ended with, we put in $140,000 of premium and we have $235,000 of cash value at year 20. We're doing fine. What I'm trying to say is I would just prefer the method of borrowing under most situations as opposed to surrendering paid up additions, especially if you think it's kind of a short-term need for the policy to pay for itself, or if you're using some policy loans from other policies to pay premiums or start new ones or something like that. Normally we wouldn't surrender money to go do that. Why? Because we want to keep all of our policies growing on the most that we can get and, potentially pay off loans in the future, be right back where we're supposed to be. You'll notice, just to kind of prove that to you a little bit, that in year 8, our dividend did change. In year 8 here, it was $1,428. In the year that we borrowed money to pay the premium in year 8, it was $1,556 compared to $1,428. Why was the dividend the same when we borrowed? It's because all the money's still there. We just used our cash value as collateral, got a loan to pay the premium. Why is it lower here? Because, that last illustration assumed that premium was paid from a loan. This illustration assumes it was not. It was paid from a withdrawal of money. So remember, guys, this kind of goes back to the basics. We have two options. We can either borrow against our policy and pay policy loan interest, or which allows our policy to continue earning on the full amount, earning the same dividends, having the same growth. We just now have policy loan interest due. This scenario doesn't have any policy loan interest due at all. But we've now taken money from the cash value. So we would expect that we're just not compounding on as much as we were. Because remember, the loan side, on this loan scenario, our cash value is compounding on the gross cash value, the total amount. On this, the surrender side, the gross isn't as high on this one as it was on the loan side, because we actually did pull cash value from it to pay the premium. But once again, I'm worried what I'm saying is coming across as we've hurt ourselves. I really hope you don't see that. If you think having $7,000 of profit tax free with no risk is hurting yourself with no outlay, then yeah, that's a problem. Okay, I can't help you. So yeah, we're still doing just fine. I'm just saying that if we had an option between the two, I would lean towards using policy loans. If I had an option, I would say you'd be crazy not to continue paying your premiums. Why would you stop? So, but I understand life can happen. But I'm not advocating for any of these options. I'm just trying to share some insight into how this works. Because obviously, we'd rather have in 20 years the 385, 241 of unencumbered cash value for you to work with and use, growing by what is that? $24,000 for the $8,000 premium. Man, we're doing pretty good. This is what we'd like. All these other options where we're having the policy pay for itself are just things we have to do in case money's not there or certain things happen. But obviously, I'm not recommending any of these. I'm not saying, yeah, you should stop paying in premiums because the policies aren't worth putting money in. It's crazy. But either way, so we have one option. We can borrow money to pay the premium. Our policy stays on the same trajectory, growing the same way with the same dividends. We just have a loan balance alongside of it that's increasing with policy loan interest because we're not going to pay that either in our assumption. We're profitable because the premium's not a payment. We're just cycling money, cycling money, cycling money. That's all we're doing. Same thing goes here. Premium's still being paid in the surrender side. We're just not borrowing money to pay it. We're withdrawing money to pay it. We have either option. I just prefer the first. This one works just fine too. The last option is different. The last option is different. The last option actually takes away the premium forever. It's gone. We call this the nuclear option. This is the scorched earth method of paying a premium or of having the policy pay for itself. Scorched earth method. So this is called, and every time I flip, lose my little pen for a second. This is actually called the reduced paid up option. Reduced paid up. And any policy can do this at any time. I'll show you what that means. Reduced paid up. So here you'll notice that we have this premium, $20,000 a year for 7 years. Cash value, $132, $116 in year 7. Once again, just trying to show you, no games here. Same exact policy. We all have the opportunity to do all three of these options at any time we want to in the life of a policy. Anytime we want to. So we're here in year 7. We got $132,000. You say, Nate, I don't have $8,000 of premium to pay. I don't have it now, and I'm never going to have it, man. It's over for me. I don't know how else to say it, but I don't think we're ever going to be able to put money into this thing again. Okay, that's fine. This is called a reduced paid up. You'll notice there's no surrenders happening here. We're not surrendering money. The premium actually goes away. You'll notice in the loan option, do we still have a premium in our premium column? We do. We're paying it. We're just using policy loans to pay it. What about our withdrawal option? Do we have a premium in the premium column? We do. We're just choosing for surrenders to pay it, withdrawals to pay it. And this last option, do we have a premium in the premium column? We do not have a premium in the premium column. This policy has become paid up. We're no longer going to put a dime into this thing. The reason this is called a scorched earth method, nuclear approach, is because once you do this, you can't change it. In other words, like in both those other options, we could pick up the premium anytime we wanted to and keep funding the policy. That'd be great for us. In this option, we actually just turn it off completely, and it's kind of irrevocable. I say that kind of, meaning you could technically go through underwriting and prove you're medically able to get the policy boosted back up, but you have to be able to do that within like a 2-year window of choosing this option. So it's essentially irrevocable. Once you have a policy that's paid up, no more money can fit. We can't send them a check to put more money in our policy. We can't pay any more money, which is why, by the way, this is also why we don't really care for 10-pay policies or 20-pay policies or something like that to do infinite banking, because those by design have a set payment schedule that once you hit that set payment schedule, the policy premium's done. You can't add any more money. which I think is foolish. I mean, even at age 80, you may have some money you want to throw in. If your policy's already paid up, you can't. So what happens here to turn off the premium, and is kind of, the name is pretty descriptive here. Look over here at the death benefit. What happened here in a reduced paid up policy is we just drastically, the insurance company will drastically reduce your death benefit to the point where the policy would be paid up. So he had $1 million of death benefit in year 7. We said, let's go ahead and do a reduced paid up policy. It pays it up by reducing the death benefit, hence reduced paid up. So we reduce the death benefit down to a point where no more premiums are needed on this policy. So no more premiums are going to go in. We don't make any surrenders. We don't take any loans. The premium is gone. No longer available. Not even no longer needed. It just doesn't exist anymore. We can't put it back on afterward. But you'll notice the cash value is going to continue growing. It's going to continue growing, doing well, growing well. Did we hurt ourselves? No. So in other words, we have 3 options. This option just turns off a premium. We can do that. Looks fine. It's just the least flexible option. So it kind of goes, I went in order of preferred to least preferred. But I say that there's actually is good reason to do reduced paid up for some people. There's a good reason to do surrenders. I'm just saying that probably 75% of the time, you want to go with that first option I shared, which was the loan option. So these 3 are the 3 ways for a policy to pay for itself. And there's not necessarily one that is just better than the other every time. This is why you have an advisor. This is why we sit down together when this would come up. And discuss which option we're going to choose in your own scenario. For whichever one would work. Like you could even go down to age, 65 and, run a comparison here, 295, 281, and 290. So in this case, by age 65, the loan option as 290, the surrender has 281, and the reduced paid up has 295. So they're all right in that same boat together between 280, 295 of how much money would become available. So I mean, it's at this point it's kind of a crapshoot. We don't know for sure which one's going to be better necessarily over the entire time. But either way, that's what we would do. We would look at this. Okay, we're leaning towards a certain option. The most flexible one is the loan. The least flexible one is reduced paid up, and somewhere in the middle is the surrenders. So these are the 3 ways to do it. And I'm pretty much done for today. I'm about to open up for questions, but just wanted to encourage you guys. This system is hopefully what you got out of this is that this is far more flexible than we're typically taught. While there is a premium scheduled for the life of the policy, we do that for your own benefit. We do that because we assume you're going to want to keep putting money into your own banking system for as long as you possibly can. We all know in the back of our mind that at some point the gears are going to switch and we'll be pulling money from the policy as opposed to continuing adding more and more into it. We know that's going to happen, and that can happen as early as around year 4 or 5. It can all the way to the life of the policy, but we don't want to limit you to doing that. I hope this also helped you in the same way it helped me, in that I'm not worried anymore whether or not I can hit premium out of my pocket. When you start, you're like, okay, I'm going to build this system based on how much money I'm pretty darn sure I can save without pushing it too far. But as you get moving with the laddering concept at times and being able to move some money and understanding it, you can actually increase the system without really fear of what's going to happen if I don't have enough money to pay all these premiums. Right now, my premium is way higher than I ever thought it would be. I have to have a pretty darn good year every single year if I was to save. I would have an amazing year if I was to save all the money to pay the premium. But I'm just moving money in if I've got it. If I don't, I'm moving it either inside its own policy or from other policies to fund it. And, my goal is I just want to get as many policies as I can down here. From year 5 to 6, we write a check for 20 grand and it grows by 25,000. How many of these do you want? It's not a complex, it's not a salesy question. That's the actual question. How many policies do you want that are mature and growing very well? My answer to myself was, I want as many as I can get, as many as I can feasibly fund that makes sense to do, even if I've got to move some money from one to the next. Knowing that any policy loans I take to be able to fund them, I can repay later if I so choose and be really rocking and rolling. So that was the whole purpose of this. I hope it was beneficial. I am going to now open it up for questions. You can type it in the chat bar, or you can type it in the question and answer bar. I got one that says, from Dwayne, it says reduced paid up is only after no loans and paid premiums up to year 7. I'm not sure what that means. Yeah, we just chose to do a reduced paid up option after year 7. And when you do that, you don't actually take surrenders or loans to pay premiums. The premium goes away. We just reduce the death benefit down to that point, a point where the policy is paid up. Got one from one question was a good question. Are these options only possible once your PUA drops off? No, absolutely not. Once again, these scenarios that we build on these illustrations on these webinars are just meant for illustration purposes. It looks more clean that way, though, doesn't it? It looks more clean that way. That's why I did it. Just easier to follow along with if we just pay premiums for those full 7 years and then drop it after the PUA is done. Normally, we'll only pay premiums for about 5 years. I had somebody say, at what point is it better to stop the PUA and open a new policy? 7 years? Nope, it's probably 5 years. I just did 7 years because I felt that it would be better for this illustration. But it's actually better to stop PUA after year 5. But this webinar was not designed to show you when you should stop paying your PUA and why. This was designed solely to show you the options you have available. I built it the way I did because I felt it did the best job of doing that. A $20,000 a year premium is over $1,600 per month. How can one do that without being subject to the MEC penalties? Once again, this isn't exactly a good time to go into depth about the MEC, modified endowment contract, but we have clients who have $5 million premium policies. So I think maybe your understanding of what a MEC is might be a little bit off base. Is there software we can access so that we can play with the numbers with different premiums? No, there is not. You have to be able to use an illustration software. But remember, if you want to play the numbers with different premiums, well, this assumes you have a policy. If you don't, yeah, I mean, so the illustration software is given to life insurance agents. It's not actually made available to the general public. So we can build them for you. We can show you different numbers. But if you have a policy illustration, and we go back to the loan scenario here, remember, you can actually take your regular policy illustration, which is this one, and you can run some scenarios yourself because remember, a loan is just a collateral assignment on the policy, just a collateralized loan. So you can actually say, okay, what if I stop paying premiums after year 7 on your own policy and just ran a normal compound interest, loan calculator or a future value calculator where it has $8,000 a year at 5%, and you just look at your total surrender value in any given year and subtract out whatever that number is, and you can come up with that yourself. Yes, a great question. Where was my chat at? I just had it. Chat. Let me see. Appreciate this presentation. Using policy loan option. Yep, great for you. Good job, Jim. Jeff, thank you for the great behind the scenes, like the options. Yep, no problem. I got a couple other questions potentially. Nate, it appears that the cash performed the best in the third scenario. Why isn't that the best option? Well, once again, yeah. Why is that not the best option? Because it might be the best option. I thought it was pretty clear. Not one option is better than the other. It depends on the situation. So you're exactly right. The reduced paid up option, where we reduce the death limit, that typically will result in the most future cash value. But it doesn't necessarily mean that it's the best, because we may not want to stop our premiums forever. We can't take it away once it's done. Once you do that reduced paid up option, it's done. Never add another dime into your policy ever. It's pretty serious. And because you've gotten rid of there's some technicalities in there that it might produce a problem when you want to produce passive income from it in the future, you might actually get more passive income with one of the other two options, even though the cash value might not be as high. That's another um, something I don't have time to go into today. But yeah, the third option did have the most in this guy's situation on his distinct policy at his age and his exact time of stopping the premium payment at the time we looked at. You're right, it did. But that doesn't actually mean that it's better for everybody. You want to choose the one that fits your scenario the best. And that's a very case by case scenario. And we will help with that so much we can. We have one from Jane. I'm guessing in the loan option, it doesn't have to be all or nothing. You can pay half. Yeah, that's a great point, Jane. Actually, yeah, exactly right. So in the loan option or even in the surrender option, you can choose to pay in as much as you want to and borrow the rest. In which case, the numbers would look better. If we only paid in $4,000 and we borrowed $4,000, or we paid in $4,000 and surrendered $4,000. You're exactly right. We can do hit or miss. That's why essentially what we say, the max premium of any policy is the MEC limit, which is probably pretty close to 20 grand, a little bit higher in this case. The minimum is technically zero, and you can really technically pay anywhere in between. Now, you're exactly right. If you were to pay less than the base premium, you'd have to borrow some or withdraw some to pay it. But you can essentially pay anywhere between zero and, let's say, 22 or something like that in this guy's scenario in any given year. Carl, what if you continue to pay 20 grand per year? Is the percent of increase greater than with reduced pay of base premium of $8,000 only? I mean, I don't. Once again, this webinar wasn't really designed to talk about that. I don't know if I have enough time to do it. Yeah, if we continue to pay 20 grand per year, we'll have a lot more cash value in it. But I think you might get a better bang for your buck if we, um, open a new policy and use some of that money to do that. But that once again, that will depend on how long you have to fund the new policy and so forth. So we very well may keep paying 20 grand per year in reality. For the best value of the highest total death benefit and cash value would be the loan model. Not necessarily. Once again, guys, you're asking me these questions. I'm trying to say as much as I possibly can that all three of these options, there is not one that is better than the other in everyone's situation. So if there was one that produced the highest amount of death benefit and cash value every single time, it very well might make sense to do that. It might be the loan model. It can depend on the year. It can depend on how long you're having to borrow to pay premiums. It can depend on how old the individual is when they do it. It can also depend on if we expect that we want to pay more in at some point in the future. So all I'm saying is it's very case by case. There's three options. I hope you never, ever, ever have to do any of them. That's my hope. I hope you would never want to do any of these three. That's actually the main goal of doing the webinar, but to show you how good you've really got it. But it is true. We may at one point have to do it, and we will decide, maybe in retirement or something like that, we'll decide which one is best for you in your situation. So with PUA to fund each year, cash still grows, just less, and death benefit remains the same or grows a different amount than have paid money into policy. Not totally sure what that means. So with PUA to fund each year, cash still grows, just less. Maybe you're saying so with using PUA surrenders to fund each year, the cash still grows, just less, and then if it remains the same or grows a different amount. Yeah, that's essentially correct, Ralph. It's essentially correct. When you take a loan, is the intent to just pay the interest annually or to pay back the total loan amount? Whenever I take a loan, because I want to take a loan, I can pay interest only or the total loan amount over amortized out. Just kind of depends on what the loan's for. If you're using it to pay the premium, whether or not you repay that loan interest or anything to it is really just depending on the financial situation you find yourself in the years to come. Another guy says loan model looks best to me. High cash value and high death benefit. Plus, you can add more cash and use it as a bank. Exactly right, Michael. It's exactly right. I think the loan option is the best for the reasons I gave. But the cash values and death benefits are so similar across the board for the most part that I would choose the flexibility every time of the loan option if I could, which I can't because I'm the banker there. That's all. I think I got to come on. Is the nuclear option always available even when the policy is owed? Yep. The nuclear option of having a reduced paid up policy is available at all times, even early on in the policy. Warning for the nuclear option. Somebody asked me, why did we stop after year 7 and so forth? If you choose to do a reduced paid up policy within the first 7 years of the policy, it very well may become a modified endowment contract. So that was one of the reasons why I, just paid base and PUA through year 7. Once again, this is an example. This is not meant to show anything. I'm trying to build the presentation the way that makes the most sense. If you do you can do a reduced paid up in year 1. You can do it anytime you want. You just may find yourself with a mech issue if you do it within the first 7 years. If you currently have an outstanding loan, can you still pay your premium with a loan from your policy every year? It's possible, yeah. But I mean, that's a good question, Doug. If you find yourself in year 7 or year 8 and the vast majority of your cash value, if the vast majority of your cash value is already borrowed out, there may not really be enough money to support it for forever. So that's a good point. So if you have like a $50,000 loan on $132,000 of cash value, yeah, it's still going to look just fine. But if you the vast majority, if you essentially don't have any money in your policy and you're broke outside the policy, that can be difficult to be able to pay the premium. But we can still do it. I'll just show you how to do it at that time. Micah says, based on your numbers, the RPU is the most efficient. Do you want to do the others because of future capacity? Yes. But once again, I didn't say I didn't want to do the reduced paid up option either. I just said that it's the nuclear option. It's because of its inflexibility. I typically shy away from it, but it's not that I don't suggest people do it. I've done it plenty of times. It just depends on the situation. That was also the main goal of this, was to say there's 3 ways to do it. We'll help you in it. The reduced paid up is the least flexible of all of them, and the numbers are not that much better. And it kind of depends on what numbers you're looking at. I mean, in year 20, the cash value was 235, but the death benefit was only 577. If you look at the loan option in year 20, the cash value was actually higher. It was 237, and the death benefit was 968. So by year 20, we were doing better with loan. Maybe the further out we go, it may help with the reduced paid up producing more benefit. I don't know. So once again, I wouldn't look at this little scenario I did on this happy little policy, 20,000 a year for 7 years on the 40-year-old, and just say, the results Nate found on this one policy is always the best. But the whole goal was to just show you what you can do. Can you switch from taking a loan when your dividend equals the premium? I mean, you can switch from taking a loan anytime you want. So yeah, you can definitely do it when your dividend equal to the premium. But yeah, you can switch from taking a loan to taking a surrender, or vice versa, really anytime you want. I think that is it, everybody. I think if I didn't get your question, I apologize. I mean, I've been running and gunning. I hope you guys enjoyed it. The goal of this was not to say, I hope you guys can't wait to pay your policy premium from surrenders, loans, or reduced paid up. I didn't want you guys to see how you could do it, but the main goal is just to clear up some misconceptions on the fact that if you use policy cash value to pay premiums, typically speaking, you're not hurting yourself. You're just moving money around. And there's a couple ways to do it. There's some that I prefer more for most situations. There's some that work better. But I just hope you see it. It makes it very flexible. You don't have to be afraid of the premium. You don't have to try to limit your premium to the minimum amount that you think you can fund. And because if something terrible is going to happen if you can't pay it. That was really the goal of this, was to say, hey, even if we have to move money around inside of a policy or from one to the next, assuming everything else is staying the same, then it would be good to go. But with that said, guys, I think I've answered all the questions. I may not have gotten all of them. If you want to meet with me, or one question, you can do it one of 2 ways. You can email me, pretty simple, Nate@livingwealth.com. Nate@livingwealth.com. Happy to chat with you about this a little more. If you wanted to schedule a time to meet with me, you can actually do so directly on my calendar. Just go to www.calendly.com/Nate Scott. So Nate@livingwealth.com if you want to ask me a question, or calendly.com/Nate Scott. You can book a call with me there. Thank you all for coming. It was a pleasure, as it always is. We'll have more in store for you. And without further ado, I'll let you guys go. Thanks for spending the time. I hope it was valuable. Have a great day.